The best of Money Matters.
Market View on Money FM 89.3.
Hi, I'm Willie Keng. You are listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch. Now, shares of all three Singapore banks extended their decline as potential US Federal Reserve rate cuts and the Trump administration's sweeping tariffs weigh on the bank's outlook. Yesterday, OCBC led the losses, dropping 4.3% to close below $15 for the first time since October 2024. UOB slid 3.3% and DBS Bank also fell 3.3%. Now, the three local banks, which form a heavy weighting on the Straits Times Index, have pulled the overall benchmark down 2%, and the STI is down 10% for the year. Meanwhile, total securities turnover value on the Singapore Exchange has increased 25% year-on-year to around $30 billion in March, with the Straits Times Index and volumes across multiple asset classes hitting record levels. So what do we make of these situations? With that, let's unpack all of these developments with Thilan Wickramasinghe, Head of Equity Research of Maybank Securities. Thilan, welcome to the show.
Thanks for having me on.
Great. Let's jump in straight into our local stock market here, Thilan. How has the STI fared so far, and what's driving markets?
Yeah, I mean, as you said, STIs ended down about 2.2% and about 10% for the year. Some of the biggest drivers actually have been the banks, but also some of the industrials and the REITs as well. But if you actually look at it, the sell down has been broad-based with hardly any green anywhere. So I think generally the bearish sentiment has really taken over the market.
Any surprises in the STI? I mean, who were the biggest movers so far that has got your attention?
I mean, I think the banks have got my attention, although that's not a surprise. They've given up ground now for about 3-4 days straight as investors take in the whole tariff impact. We've also seen the REITs, which have been a bit of a surprise. They've actually been giving up a bit as well, particularly the names like Mapletree Logistics Trust, which is down about 10% today. Treasures Logistics Trust, which is down about another 6%. I think there's a lot of concern, U.S. yields spiking, and also whether tenants are going to be in distress with all these supply chain moves happening right now. So I think, the general expectations of the REITs would hold up, and that hasn't actually happened. We also saw venture coming off about 4.5% as risks of spillover from additional tariffs on the semiconductor sector might come at any time. And we also saw SATs down about 7% and Singapore Airlines down about 1%. I think there is some fear that, slowing global growth will have an impact on travel as well.
Yeah, I mean, you've spoken about a broad-based sell-off and also a couple of these Singapore blue chips. I think I want to place particular focus on our three Singapore banks. I mean, shares of our local banks have extended their decline. Potential US Fed rate cuts and the Trump administration's tariffs, so far has been weighing on the bank's outlook. Thilan, I want to get your views on the tariff impact. And which bank do you think will be hit the most here?
So I think the sector has generally been bearing the full brunt of the tariffs. And I think the risks will remain for a while. And I don't think right now it's about picking one bank versus another, because I think there's still too many moving parts and too many unknowns. I think for the US, it's becoming very, very clear that tariffs are not just a bargaining tool, but a central doctrine of the administration.
Right.
So this is going to create a lot of volatility, especially in the markets Singapore banks operate in. If you look at a lot of the East Asian markets, they have been hit very badly with tariffs. And you can even argue that Singapore has been hit pretty badly with tariffs, given the fact that Singapore has a trade deficit with the US as well as an FTA with the US. We also saw effective tariff rates of 116% running on China now, and which is a big market for these banks as well. So all of this is going to have an impact in terms of earnings and performance. Now, one of the things that I'm kind of looking forward to is the first quarter results that will be coming in a few weeks' time, and not really to see what's happened in the past quarter. I think that was the last non-tariff quarter, so there should have been some improvement in terms of wealth management, in terms of loan growth, and even margins could have held up a little bit better. But what we are kind of looking for is what is management saying? What is guidance from management? Because if you think about last quarter, general management guidance was cautiously optimistic, but that was for a very, very different world. So as risks have changed and growth profiles have changed, we'll be watching to see, how these banks are going to be positioned. Now, in terms of picking a bank, I think, as I said, it's a bit too early, but I think generally for the sector, one positive silver lining is the fact that the banks are going into this crisis from a position of strength. They've got more than 100% provisioning levels. They've got very strong capital. They've got very strong liquidity as well. So I think as this crisis plays out, that will be an advantage.
Yeah, I think it's pretty interesting that you brought up a point on management guidance. And following up from that, Thilan, banks have also mentioned about share buybacks here. And I just want to get your thoughts here. What do you think about the share buybacks from banks? Do you think it's a signal of confidence for investors?
I think part of it is confidence, and I think part of it is the fact that they have announced a capital management plan. So they have announced the fact that they will be coming into the market and returning capital to shareholders. So this is partly, that the capital management plans that they put in place back in February when they announced their fourth quarter results. So I think, as I said, the banks are entering this crisis from a position of strength. So I think part of that is a signal of that, but it is also partly a function of capital management.
Yeah. Just moving on, to the broader Singapore market, we are actually looking at the total securities turnover value on the Singapore Exchange, which has increased 25% year on year to around $30 billion in earlier March. And Straits Times Index, with the Straits Times Index and volume across multiple asset class hitting record levels. I mean, what's your view here on the Singapore Exchange and the broader market outlook?
Yeah, so I think, if you look at, last month in terms of where some of the turnover came from, it was from industrial, financial, utilities, healthcare. So I think sectors where investors have been chasing yield and also some diversification from some of the U.S. stocks, which were already toppish even before the tariffs. But I think, if you think about Singapore, you're going to need a little bit more than that to make the Singapore market great again.
Right.
We saw some positive moves from the first set of recommendations from MAS, such as the $5 billion stock investment fund and channeling a little bit of private wealth into the market. But I think we also need to see the supply side picking up, and particularly what I mean by that is more exciting IPOs. Unfortunately, I think the current market environment, that's going to get sidelined. But ironically, if you think about the Singapore market, it actually could be a beneficiary of the current, what's currently happening, as investors might see it as a safe haven. We did see that playing out during COVID, and we did see that playing out even last year as well. Valuations have come off. Yield, it's a yield market, so there is pretty attractive yield. If you do see Fed rates coming off, then it'll actually make it even more attractive. So I think you may actually have some flows coming into Singapore as investors hide out all this tariff uncertainty.
I think you have pointed out about the listings from the Singapore Exchange. I think what's interesting is some of the Hong Kong companies, they have been attracted to Singapore here in the form of Singapore depository receipts. Do you think we'll be seeing more of such companies coming here in Singapore to sort of broaden the volumes on the SGX?
I think the SDRs is positive, and I think, it gives investors in Singapore some choice as well as convenience. So I think that makes the market a lot more relevant, especially for newer investors to come in because they might not want to just play Singapore, but they might want to look at it from a regional point of view. So I think it's a positive. We may see more SDRs coming through. We have the Thai SDRs, we have the Hong Kong SDRs, and I think Singapore as a regional trading venue, I think it makes a lot of sense for more SDRs to be listed here.
Zooming out from the Singapore market here, you mentioned, Thilan, about Singapore getting hit badly by tariffs. We have not been spared from Liberation Day. In the regional economies, what do you think about the challenges they are facing in ASEAN? And, how do you think tariffs will impact these countries, especially now we are seeing new tariffs being imposed, and since the US is a major trading partner for ASEAN?
Yeah, I mean, I think there's no argument that the tariffs are bad for Southeast Asia. I think the tariffs imposed on ASEAN was much higher than expected, especially for countries like Vietnam, Thailand, Indonesia. So it will have a negative impact. A lot of investor flows, particularly into ASEAN last year and even the year before, was really driven on this thematic of supply chains moving from North Asia to Southeast Asia now, and particularly to countries like Vietnam and Indonesia. Now with high tariffs, while it won't cancel the potential for North Asian supply chains to relocate, it most likely will slow them down. I think many companies will be pausing investments to assess whether making capex plans is worthwhile as tariffs and counter tariffs flow between different countries at the speed of a tweet. So I think that's going to be something to watch out for. As a house, we've actually downgraded the ASEAN 6 GDP by about 0.5 percentage point for this year as well as next year. This still implies growth, though, and not recession. Another point is that if you have slower global growth and demand destruction, that can actually bring inflation down in this region.
Right.
This may actually open the door for some of the central banks in the region to make some cuts, particularly if the Fed does as well. We're actually looking for about 50 basis point cuts in Indonesia, Thailand, and the Philippines this year. And we think that even Singapore's MAS might ease next week. And on a final point, as I said, from regional countries, while we were surprised that Singapore got hit, at least Singapore is in a less bad position. This is because the government has ample dry powder to introduce more fiscal stimulus if things turn sharply worse. By our estimates, the accumulated fiscal surplus over the current electoral term is around 14.3 billion Sing dollars, which is about 1.9% of GDP. So this can be tapped over the 2025 fiscal year without needing to draw down on past reserves. So we think the government might actually provide a fiscal stimulus package by around third quarter this year as well.
So then I initially wanted to ask about what's on your radar for the week, but as an investor, I kind of curious to know what's your top sector pick here. And, could you please share with us?
I think you need to be defensive going into, a crisis like this. So I think what you really should be looking for is companies that generate a lot of cash, that you have a long horizon of visibility in terms of earnings and cash and coming through. So I think from that point of view, Singapore does offer quite a few choices. One is some of the industrial names like ST Engineering, Sencorp Industries, where you've got very strong order books that link to global themes like defense and utilities. So names like Singtel, which is generating a lot of cash, and they are going through corporate restructuring as well. And I think also looking at some REITs is a good idea. I know you're starting to see some, you haven't seen the sector really performing. But I think if you do have the rate cuts coming through, some good quality REITs like CICT and Fraser Centrepoint, which are very domestic-oriented names, should also do quite well.
We have been speaking with Thilan Wickramasinghe, Head of Equity Research of Maybank Securities. Thank you so much for your insights, Thilan.
Thank you.
Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.